Good morning. Welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host for the next 60 plus minutes as we go around the globe to discuss the issues related to retirement, the markets, technology, personal finance, so much more. We've got a great show for you this week, so just sit back, relax, and enjoy this episode of BRN Sunday. Let's kick things off with a look at the latest social media trends. And joining me on the line from San Francisco, California, where you finally made it home for the rest of the year, Devin Banerjee, Senior Financial Services Editor for LinkedIn. Devin, welcome back home.
Thank you, Jeff. How are you?
I'm doing well. I hope you had a great week. I know you spent some. I was in Boston. You were in New York, but that's still a long trip. Maybe not as long as the UK or India, but it's still a long trip for you.
Yeah, I'm certainly, as you said, I'm staying home for the rest of the year. No more airplanes for as long as I can manage.
Good for you. Breathe that beautiful Bay Area air, and don't get that recycled air.
Yeah.
And plus, you don't get those. The radiation probably that gets in when you're that high in a plane. Anyway, as I digress, which we should actually absolutely talk about sustainable investing at some point on the program. But let's dig into it. So. Lots going on the platform this week. What's top of mind for you and the team over at LinkedIn?
Yeah, absolutely. This was one of those weeks, Jeff, where the conversations were just stellar across the board. We had some huge topics. The first I'm going to mention is some proprietary research we did on all of the different ways, and actually the expansion in the different ways that people are making it to the C-suite. So if you think about the traditional C-suite, you've got your CEO, CFO, COO, maybe a CHRO, human resources, but now we're seeing about 57 different ways, different C-suite titles,
wow.
Different ways to get into that C-suite. And there's some really interesting new ones or fast-growing ones. So what are the fastest-growing ones? Chief Growth Officers, Chief People Officers, Chief Revenue Officers, Chief Experience Officer. So those are the top four. Some other ones down the list that I found really interesting, and I'm seeing anecdotally a lot, Chief Diversity Officers, Chief Innovation Officers. So these are roles where like the changing nature of corporate America and business is really starting to necessitate people in these roles. And CEOs want direct reports focusing on topics like, as I mentioned, diversity, innovation, growth. Chief People Officers are really interesting. They're not always the CHRO. It's more people thinking about culture and experience. And so that traditional C-suite is just growing a lot. We also saw a really interesting trend among different genders. So some of these really newer titles are seeing a higher proportion of women in them than other traditional C-suite titles, in large part because there hasn't been that historical precedent of people in that role, which leads people to think, those are the appropriate people for these roles because those are the ones who've had these roles in the past. So for women, Chief People Officers, Chief Diversity Officers, Chief Clinical Officers, those are the top three where our data is showing women in those roles. So really interesting conversation unfolded on this story that we featured. People talking about, their paths into these roles, and also some hope and optimism that, again, there are 57 different ways to grab that chief title now.
One title I didn't hear, Devin, was Chief Podcast Officer. Have you, was that the 58th way, perhaps?
You should add that to your profile, and then we will grant you that honor in our data.
I might put that in. Sorry, I didn't mean to. I didn't. Just wanted to add a little levity. But what I thought was really interesting in your point, and from the discussions on the platform, was that the unconventional way, if it doesn't exist, but they create it. That I think is,
Yep.
You don't have that inherent bias that existed. Like, oh, let's get someone that was in the position similar to them, or you know how it is when you're hiring somebody.
That's exactly
and you're
right.
pursuing an employee. You got to find someone who's the Goldilocks, just right. And I really love the fact that when you create something, and actually as an entrepreneur and someone who likes to build things, I would prefer not having a role that was predefined and one that I can define myself.
Yeah, absolutely. We saw several people in the conversation talking about how they effectively created this role for themselves. They were in organizations, they saw a need, they saw that they were filling this need, and they went to, and in most cases, their CEO or other members of the C-suite and said, "We need to create this role, and guess what? I'm the perfect person for it." So, as I said, a lot of hope and optimism that new ways to the top are being created.
Yeah, amazing.
A couple other interesting stories this week, kind of on that theme of the changing nature of this workforce. So two a bit pessimistic ones, and I'm sorry, but one is just the changing environment for farmers in the United States, especially small farmers. We featured a story from Time Magazine, which called the crisis for small farmers in America the worst crisis in decades. Bankruptcies, these are Chapter 12 farm bankruptcies are up about 50% in the Northwest U.S. and about 12% in the Midwest. That's just over the past year. The data shows that this country has lost more than 100,000 farms in the past decade. Farm debt is at an all-time high. The trade war, of course, this past year is not helping. That was a big driver behind those Chapter 12 bankruptcies. And also changes in weather. You see these stories every once in a while. Climate change is really, throwing the farm business for a curve and really affecting this business. And this, has been the lifeblood for a lot of communities and parts of this country, and that is really changing. So we saw, as usual, an interesting conversation unfold around this topic. People talking about how to pivot, how to strategically, change how they're approaching farming. So organic farming is booming quite a bit. So that's an area where consumer demand is really driving growth in this space. But we even see some people in and around the farm industry talking about reskilling and finding other career paths. So really, as I said, the changing face of the workforce in this country. One more topic I'll mention on that, which I found really interesting, is that where are the secretaries going? So in this country, office and administrative support jobs are actually sliding quite quickly. And this is cutting off, what has for a long time and for many people been seen as a reliable path into the workforce, into eventually the middle class, especially for women historically, also for people without college degrees in the past. If you think about it, this has been a viable, robust path for them into the workforce. And we've seen since 2000, more than 2 million of these administrative jobs actually disappear in the U.S. That's according to the Labor Department. And they're bracing for more of these expected declines. So this is because of outsourcing, automation, technology tools that are helping people who previously maybe had administrative support, but now have tools to manage their calendar and schedule and communications, stuff like that. So again, all under the umbrella of just the changing workforce here in the U.S.
Yeah, I got to say, I love the fact, and just to pivot back to the small farmer. And you're right. America was an agrarian society. In fact, I think we still feed the majority of the world. But it's probably the bigger farms. But I love the fact that, when I think of LinkedIn, when I typically thought of LinkedIn, Devin, and this is just my own presupposition, is that, I think a lot of technology and just maybe, I don't know, white collar. Is that even a fair term to use? Like those types of jobs. But it just shows me that LinkedIn is a platform that many different workers or employees frequent, and therefore the content that you're providing is not just tailored towards tech, although you see a lot of tech and investments, but these other things. And so I guess I don't know, it's a backwards compliment, I guess, or a backslap compliment.
It's true.
Sorry.
No, it's absolutely true. The news that we're featuring and the conversation that we see, trending even before we feature news is coming not just from white collar workers, and it's across all different industries and pockets of the country, and increasingly different pockets of the world. As you know, I think we've talked about, Jeff, almost 3/4 of the LinkedIn membership is outside of the U.S. And so these conversations are taking place all over the world.
Yeah.
I know we're running low on time. I just want to throw out a couple more because, as I said, it was such a robust week. We had a really interesting conversation around the exploding cost of childcare here in the U.S. It's risen about 2,000%
Oh, my Lord.
over the past 4 decades. I actually saw off our platform, but relatedly, a conversation among some financial advisors talking about how could exploding childcare costs precipitate the next downturn and financial crisis. So that was a story in The Atlantic we featured. Let me see another one. I really like this one about dollar stores booming. When you think about those leading indicators of where the economy is going and how the consumer is feeling and doing, dollar stores, so Dollar General in particular, the company is set to open 1,000 new stores just in the next year. And so, we're seeing kind of that trend, people being more conscious about spending, really picking up. And then a couple others that I found really interesting is some recent data around the highest earning majors in higher education. A lot of young people think about this stuff, and parents actually probably more think about this stuff for their children. But math, computer science topped that list. This is data from the Department of Education. And then we had another related story about the most regretted college majors. And on that list was English, education, and biology. So, I'm not implying people should I'm absolutely not implying, in my opinion, that students should decide majors based on these things, but that's what we're seeing.
Yeah, well, I think people oftentimes, I think as you progress in your life and you get more experience, you figure out what you like and what you don't like. And how can you possibly know what you like at age 18 or 19, 20, 21? I didn't know. I thought I knew, but I think you progress. And so I don't, maybe regret's the wrong word, perhaps. Maybe people are just evolving and they decide that, hey, because I think you have to look at things as like got you from point A to point B, and that's just your journey. And I think that there's certainly some majors that are more profitable than or some degrees that can be more profitable than others. But if you're not doing something that you're passionate about and you don't like, you're just not going to be happy. So some people enjoy teaching, some people don't. Some people enjoyed teaching, and maybe they don't enjoy it now like they did 10 years ago.
And also, as we've talked about so many times, you can quite easily, there's so many opportunities to reskill, to learn new skills, to pivot, to evolve. There are so many, technology tools with the internet to learn these things. Employers are starting to take this on, continual education and ensuring that their workforce is up to speed with the latest skills, especially around technology and data these days. So it's not like you go to college or grad school and then that's all your knowledge for your career.
Yeah, I mean, you can log on. I know that LinkedIn has training, but also YouTube. Right. You can go to YouTube, and if you type in, how to change a light bulb, maybe that's not good. How to change your faucet, you can learn to do those things, and you can pick up coding and all those things. So great suggestions as always, and Devin, and I'm looking forward to seeing you on the television network on Monday. So we will talk with you again very, very soon. And so until then, enjoy the rest of your weekend and enjoy that Bay Area air.
Thanks, Jeff. Take care.
Bye.
Bye.
Yeah. Welcome back, and now we're going to shift gears to talk a little about technology. And who better to talk about technology than our friend, Mr. Daniel Klein. He is a senior technology and consumer products reporter with The Motley Fool. Daniel, how are you?
I'm good. How are you?
I'm doing well. It's obviously cold weather has settled in here in the Northeast, and I just returned from a trip this week to Boston, Massachusetts, where it was exceedingly cold and it snowed. Bet you don't get that in Florida.
I was in Virginia where it was cold but not snowy, and I'm on my way to North Carolina where it is same thing, cold but not snowy.
Oh, well, I hope you're lucky to be in West Palm where it's beautiful. So I want to talk about holiday shopping, but let's start off with a news story that you you shared with me about a new airplane seat design, and you and I have both been on flights. I was on one this week. I think you're going to be on one next week. So we're often traveling. So what can you tell us?
Yeah, so I fly 2 or 3 times a month, so this is kind of a big deal for me. And through the years, as you know, for the most part, airline seats have gotten smaller, the space between seats has gotten smaller, and companies haven't done very much to deal with that. And what you're starting to see is you're not going to get more space, but companies are looking at, airlines are looking at more clever seats. And I fly Southwest. And if you're on a fully updated Southwest plane, it's the same amount of space, but the way they configure the seat, you can put the tray down and work comfortably instead of
Mm.
feeling like you're a Tyrannosaurus Rex typing with your arms in. It has little flaps on the headrest that you can sort of adjust so you can, take a nap better. It's markedly better to the point that when I get on one of those planes, I am genuinely excited because I know I'm going to get some work done. And now today I saw a news story about a company that has taken this a little bit further. A company called Universal Movement, and they've built an airline seat that sort of has some built-in wings and some other features where, again, the seat doesn't take up more space, but it's more comfortable and it's more easy to take a nap.
Well, as a routine, I don't fly first class, so I usually fly coach or economy. This is really good news. You know, I guess I'm excited by the fact that the airline industry is taking our comfort a little bit more seriously, not just shoving us into metal tubes and flying us across the world.
Yeah, I mean, this is absolutely better. It's and the challenge is these new seats can be retrofitted into older planes,
Ah,
and what will force that to happen is competition. So we're starting to see changes in fares. My flight on Sunday to North Carolina, I'm flying Delta, which is something I never do, but they had an ultra economy fare. It was like less than $50. And that fare entitles me to nothing. I don't even have a seat number yet. And when I get there, I'm sure that I'm the last one to board. I'm sure I have the least priority. But because I'm only going on like a 36-hour trip, I'm just bringing my backpack. I don't have any checked luggage. I don't have an overhead bin bag. I don't care if I'm in a middle seat. It's going to be 6 in the morning anyway. So now what they hope is that I'll pay them to buy extra stuff. And I might pay them if a third of the seats are extra comfort seats or whatever you want to call them.
mm.
So there's going to be strategic ways airlines use this. And your better airlines or your more customer focused airlines like Southwest look for innovations like this just to make flying more comfortable. People like Delta, who I'm not a big fan of, tend to look for this kind of thing as a way to charge more. But there are times, I know on a cross country flight, you want to charge me $50 more for a more comfortable seat? I'll pay for that.
Yeah, I don't know. I won't pay for comfort, but maybe I will if I'm flying 5 or 6 hours or more across the country or across the globe. But I guess it remains to be seen. And I find it interesting when you run a business, you're supposed to be customer centric. So, so, it's your comments that you were making. And I know you're not as bullish on Delta as you are on Southwest, but you would think that if you want returning customers, you would do what you could to accommodate those customers. But that just
Well,
me picking up on that.
yeah, I think the full fare airlines cater more to the business class, first class traveler
Yeah.
and consider those of us in coach as pretty much packages. There's not a lot of attention paid to you. Like I'll fly JetBlue sometimes too, and they have a little bit of a class system, but everyone gets free television. The internet is free. There's snacks. There's drinks. You don't feel like a second class passenger. Southwest, if you've never flown it before, can be a little confusing with the no assigned seats. But once you know the system, it's very democratic. And they treat me better because I use their airline, a lot. I think it's like something like 38 one-way flights this year
Wow.
because they look at each segment as a trip. So I get some perks, but if you're only flying occasionally, you could pay for some of those perks, like to get on early or change your fare. I get standby. I can stand by for free within 24 hours. So there's a lot of perks in being loyal, but there is a clear focus of some airlines on revenue over customer. And then there's airlines like Spirit or Allegiant where they are telling you, we're going to give you the cheapest fare possible and you're getting nothing. It's practically bring your own seat.
Or sit on your luggage. Okay, Dan. Well, that sounds quite interesting. Let's shift gears. We're in the throes of holiday seasons. Do you have an update on Black Friday, Cyber Monday, where we are in the holiday retail season?
Yeah, so there's one headline I see all the time that I sort of want to correct. Overall, spending is up. It's going to be up somewhere between 3.8 and 4.2% for the total season, according to the National Retail Federation. And digital is growing while brick and mortar shrunk slightly. Even that is a bit misleading. But the headline you'll see is digital is bigger than brick and mortar, which is just not true. It's still somewhere in the high 70s, maybe even 80s percentage of sales going through physical retailers. And the number of people who actually visit stores is higher than that because when you buy something online and pick it up at the store, that's considered a digital sale, but obviously the store plays a role in that. So we are seeing an omni-channel model winning. So retailers like Walmart, Target, Best Buy, who've really integrated their websites with their app, with their store, those are the places where people are spending the most money, with the exception being, of course, Amazon,
Yeah.
because about 40% of all digital sales took place on Amazon, and digital sales are up, let's call it about 20% for the season.
Hey Dan, I know Amazon rolled out some retail stores. I think I seem to recall us talking about it in one of our episodes. Are how would they be impacted? I mean, do people actually go into an Amazon brick and mortar store?
So, so Amazon brick and mortar stores are still in, well, let's call it experiment stage.
Ah,
I've
okay.
been to in Bellevue, there's an Amazon bookstore, and it's a lovely bookstore, and it sells some other products. There's the Amazon four-star stores that only sell the highest rated products. There's the Amazon Go convenience store, which is built more around like lunch and snack pickup items. There's also Amazon, call them kiosks or store within a store within Kohl's, and Kohl's accepts Amazon returns, which is an important part of the business this time of year. So what Amazon has tried to do with its retail presence largely, and they're doing this with Whole Foods as well, is facilitate the return and delivery process. At a Whole Foods, you can use Amazon Locker. So if you're afraid of porch pirates and don't want something delivered to your house, or maybe you bought something for your spouse and the shape of the box is going to make it clear what it is, you can have it delivered to an alternative location like a Whole Foods.
Porch pirate? Is that I have never heard that before.
So that's the term for the people who steal packages off your porch, which is an ever-growing problem, especially during this time of year.
Oh, wow. Okay, that's right up there with greenwashing. Very interesting. Well, yeah, I mean, it's kind of runs counter to what we've been talking about, which is, what we hear, which is people are primarily buying things online. But as you and I talk about all the time, I'm not buying a pair of shoes online if I can't try them on first because I don't know if a 10 and a half, usually wear a 10 and a half or 11. Sometimes it's different by manufacturer. So like with clothing and those types of things, I like to try them on in the store, see them, touch them, feel them before I get them. That's just me.
Yeah, and the reality is foot traffic in malls was down a tiny bit. We don't know the exact number, but I've seen a bunch of estimates that put it at like 1 to 2%. The reality is, though, consumers are skipping the smaller stores in the middle of the mall unless they have a truly differentiated product. So, yeah, they might go to GameStop because GameStop has video games, they can see them, maybe they can play them and try them, but they're skipping a lot of clothing and they're going to the bigger box stores, the ones that have done it right, your Targets and your Best Buys and Kohl's to a lesser extent, Macy's maybe, because you can put your hands on things. But if you decide you want to try it on, but then have it delivered to your house, you can do that very easily. So this omni-channel hybrid shopping is really becoming the norm, and I think you're going to see more and more of it.
Yeah, and Dan, before we go, I want to ask you about we talked this week about Disney Plus, and I've been watching The Mandalorian. I don't know if you saw
I,
Friday's episode because we're
I
recording on
haven't seen
Friday.
Friday's episode, but I'm caught up other than that.
Okay, so give us your. I kind of like the show. I think we should do a little Roger Ebert and Gene Siskel review. I mean,
So
do
that's
you
how I
like it?
started my career doing movie reviews on public access television. Yeah, so I think the Mandalorian is cinematic. It's made like a movie, and every episode, has a lot of Western tropes to it. But every episode sort of doles out like a tiny little bit more of information without me giving any spoilers, where you start to see a bigger picture of who this character is, a character whose face we haven't seen, whose name we don't know,
Yeah.
who has a traveling companion. I'm sure those of you have seen the toys out there, at least the hoped for toys, that doesn't really talk and is very slowly showing you who, I'll say he, but we don't even know that it's a he is. I am super excited to watch it. I will probably watch the episode tonight after my wife goes to bed. And again, I go back to this is a masterstroke by Disney. They have given you a series that everyone is talking about. They're giving it to you one episode at a time. So that means you and I can discuss it like we would traditional television, as opposed to the way Netflix does it when Stranger Things has a shelf life of about 4 days where it's in the zeitgeist, in the public knowledge sphere. So it's really a smart thing. It's been done well, and I recommend anyone who likes Star Wars and has a tolerance for violence, it's a little bit violent, that you check it out.
Yeah, that baby Yoda is cute. It makes me want to have like one of those sitting around. It reminds me of my cats. Well, Dan,
You're going to have to wait a couple of months. Jon Favreau actually did an interview this morning that thanked Disney, Jon Favreau, the creator, writer of The Mandalorian, and said that Disney made a strategic decision to forego millions of dollars, probably tens of millions of dollars, because creating those toys would have been a tip-off for some of the spoilers for the show. If you knew there was a baby character who looks like Yoda, that would ruin the reveal in the first episode where you first met the character.
Yeah, and you pointed out, I think before, that a lot of times they do that so as not to spoil. If you produce a character or some kind of toy or something, it can spoil the reveal. So very interesting. Well, I'm checking it out, Dan, and always a pleasure talking with you. And I look forward to seeing you this week coming up on the television network.
I'll see you Tuesday.
Bye. Welcome back. Now we're going to shift to markets. And who better to talk about markets? Oliver Rennick, the lead anchor for the TD Ameritrade Network, and Kevin Kelly, co-founder with Delphi Digital. Gentlemen, how are you?
Yo.
Hey, well, I hope you guys had great Thanksgiving weekend. This is the first time I've chatted with you since the holidays, so I hope you enjoyed yourselves immensely. Kevin, I'm going to come to you, start with you today. Why don't you give us a breakdown of what the week that was in markets?
Yeah, I mean, big news really today and much of this week. I mean, you've continued to see this kind of risk-on rally with, stocks, even some of the high-yield corporate bond market. You had a pretty massive beat to the upside on the jobs report this morning, which a lot of people were looking to. And, I do want to take a quick, second, give a shout out to Oliver here. I don't like, tooting his horn more than I need to, but this is certainly really,
I like where this is going.
Yeah, I like giving credit where it's due, though. And this is something where, we started talking about this trend a few months ago now, and he's one of the people who kind of really brought it to my attention. We dug in, went back and forth, has been pounding the table ever since. And this goes back to the idea that we saw just market consensus for slowing economic growth and really kind of this doomsday scenario heading into 2020 with the inevitable, global recession that everyone was calling for. We found just that market consensus was just, stronger than anything we'd ever seen. And so what have you seen since then? You've seen this kind of reversal in some of the key economic data. I mean, it's not saying everything's all sunshine and rainbows yet. You're starting to see kind of the global PMIs really bottom out and turn around. And this is something, again, that, he was hitting on a few months ago, saying, what if, things aren't necessarily that bad? And what happens, a scenario where everyone's pricing in, the Fed to cut, rates at that point, I think was 2 more times by year end. And now you've started to see a backup kind of in that expectation from the market because the Fed has come out and said they like where they are with their current policy stance. And they're probably going to be a bit more neutral here going forward, which means you're most likely not going to, it's pretty much, a certainty at this point, in my view, especially with today's jobs numbers, you're not going to get another rate cut when the Fed meets next week, right? So I think it's just a really kind of interesting dynamic now where the question is, can we actually have a fundamental improvement in the outlook to continue to bolster, stocks and risk assets? Now, the fact that you're getting some of these major central banks, especially the Fed, starting to kind of pull back from the accommodative monetary policy.
Well, Kevin, that's amazing. And Oliver, I hope the check is in the mail to Kevin for that those positive comments.
You already got the kickback from, being my sounding board when we were talking about this because, sometimes it's just like, it's you don't really have any particular, there's no way that, we can have some particular insight in the economy, but just being able to see the way consensus forms and when it just gets so lopsided. That's when Kevin and I were talking earlier this summer about. the risks then to if that consensus falls short, and that's basically what's happening. So the next step is really just is there some trade deal that actually means something? That's kind of the last chip to fall, and it is a massive one. So all of that could totally go the other way.
Yeah, I got to think we're in the last couple weeks of the year. Is this typically a busy time for the market, guys, or is this more of a slower time for the market, just given the holidays and things going on? Any ideas on that?
After last year, I don't know. It's all up for grabs at this point. It was, it was a bloodbath this time in 2018.
Well, let's go ahead, Kev.
We went back really quick. We looked at some of the quarterly data for the S&P just going back, quick 25 years. And Q4 tends to be, on average, the best performing quarter, but it also is one of the most volatile. And for a number of the reasons you mentioned, Jeff, it's a little slower, but trading volumes are down. So when you have lower volumes, typically you get a bit more volatility within the market. And then to Oliver's point, obviously the recency bias of last year, especially where the market is right now. Again, we've only got, I don't know how many trading days left, but really only a handful left until year end. I think the market is still, a bit vulnerable. We're definitely not out of the woods yet.
And Kevin, I want to ask you about crypto, because when we talked last week or the week prior, crypto had really gone, especially Bitcoin had gone south a little bit. Any thoughts about that? Have things kind of rebounded a little bit for cryptocurrency and Bitcoin?
Yeah, I'd like to say that they have, but to be quite frank, they really haven't. You've got Bitcoin still now kind of hovering between 7,200 and 7,500. It's a level that, we continue to see, pretty drastic legs down, and then you'll see a bit of a rebound and people think, maybe the worst is over. And then Bitcoin is basically just, and all of crypto, at large has really just kind of bled out since earlier this summer, going back to the earlier points we were talking about when you had this kind of world's going to hell in a handbasket market consensus. And I think what's interesting too is if you look at kind of the expectations for the market for Fed interest rate cuts, and looking specifically at December and the March 2020 dates, that tracks, not perfect one-for-one correlation, but tracks pretty well the trend in what you've seen in Bitcoin's price too. Again, because of some of these improving, economic data that we're seeing come in, the Fed saying that they're on hold now, the fact that you don't necessarily have that potential, one of the key catalysts this summer, which was more accommodative monetary policy, especially from the Fed, kind of supporting Bitcoin. You've seen that, crypto assets in general just kind of slowly bleed out as everyone just kind of scrambles or tries to find, a new narrative to attach to.
Yeah, Oliver, just coming back to you. Thanks, Kevin, for that. Oliver, coming back to you. This week you had Christina Hooper on from Invesco talking about her economic. Well, you didn't, but the network did, talking about her economic outlook. You're hearing a lot. You and Kevin just weighed in, and you gave your thoughts regarding the sentiments. But looking into 2020, what are some of your guests saying? Are they bullish? Are they bearish? Had they pulled back from some of their more bearish, we're headed for a recession tomorrow kind of mentality?
Yeah, I think pretty much that's the case. I think there's a general, trepidation in making forecasts with the trade overhang. Nobody really wants to sort of make a call on a very, binary type of event. But, I would say that I think it's a little bit, nobody really knows, right? It's kind of a game of psychology and guesswork. But one of the big things I think that's happened is you've had a pretty wild sort of couple months where there's impeachment proceedings in the U.S. and there's signing of Hong Kong support bills. And it's like, if there's a time where do you think China would really push back and try and play hardball, it'd probably be now, but it just doesn't seem like that's what's happening. So I think that even though there's some pretty good logic for a trade deal happening, nobody's just really willing to give anything in terms of a big, bold forecast without knowing those. I think everything has to be contained to an if-then scenario. And to connect this to the overall theme of the improving global situation even without the trade deal, the if-then is definitely okay. Well, if there's a deal, then what? And most people assume that if there's a deal, then yes, bonds and gold will come down, but stocks will also go up. And I think that where there needs to be more discussion is about, well, how far bonds will go down and how quickly. And do stocks go up in that scenario apart from, the first initial injection of sentiment. So the market's already very expensive again, most expensive on a forward basis since January 2018. So if the trade deal does not turn into real earnings growth revisions, that's going to be a problem for the stock market, even if it removes the cloud that could cause bonds to drop. So that is an awkward scenario where stocks need a lot now beyond just sentiment, whereas bonds seem to need very little and gold needs very little. Not very little because we're seeing resilience in both markets still, but that overhang removed would probably be a big deal. And I think that the Bitcoin stuff is more important than ever because this is where the thesis basically developed from, was talking with crypto people and Bitcoin people and understanding that there's a lot of overlap in the fundamental case that people who like this asset class as a way to hedge, it overlaps with the same reasons why people own gold and bonds. So that was kind of the heads up that this turn was coming because Bitcoin is the most levered to some of these bearish scenarios, and it was the first to give up. So now the question is, all right, has the Bitcoin sell-off from the high been about preceding the rebound that we've seen, or is there still more to come to the downside? If there's more to come to the downside in BTC, then I think you have to pay attention to that for traditional investors as well, for what that means to gold and bonds. I think it's time we have to accept that it does have macro ties.
Yeah, absolutely. Well, guys, thanks so much. Really appreciate you jumping on the line. I know you both are busy with your incredibly busy work schedules, but always appreciate your insight. Have a great weekend, and we'll talk to you again next week.
Great. Thanks, Jeff.
Bye, guys. Welcome back, and now it's time to talk about retirement. I know the show is about retirement, but we like to focus on a lot of different things on the program. And now joining me to talk about retirement, Ms. Alessandra Melito. She is the retirement reporter for MarketWatch. Hi, Allie. Welcome back to the program.
Hi.
How are you?
Thank you. I'm good. How are you?
I'm doing great. Did you have a good week, a post-Thanksgiving week?
Yes, I did.
Nice and relaxing?
Been a busy one.
And busy?
Yeah, busy.
Good. So tell us, what's top of mind from your perspective this week related to retirement?
Yeah, so I'm not sure if you saw, but Senator Rand Paul had made a proposal. He announced a proposal earlier this week about fixing student debt by letting people dip into their 401k accounts or IRA accounts. So that was something that happened. I spoke with some financial advisors, many of whom said that this was not a good idea whatsoever. And the reason being that although student debt is a major issue for lots of people, this proposal kind of creates or exacerbates two problems as opposed to fixing one. A lot of Americans do not save enough for retirement as it is, and to take that option of having a 401k plan and funneling that money into student debt would mean that that young worker doesn't put money towards their retirement, and there are a few issues with this. So first, the proposal. Under this proposal, an individual would be able to put up to like $5,250 of their retirement account into student debt or college expenses, and it could be numerous people. So it could be one individual who's paying down their college debt or college expenses, as well as parents. So, mom and dad could both each put $5,000 and change into the plan. But that would mean that one, the young adult who now has a job with a 401k isn't putting money away for their retirement, and two, it's taking money out of your parents' retirement savings to pay for student debt. Which would therefore affect how much that they have in their accounts and how that those accounts grow and all of that. The plan, what he had suggested and posted on Twitter, is that by doing it this way, where you're putting money into a student debt, you are paying off the loan faster and with less interest. But he makes a few assumptions, one of which that a young adult has access to a 401k, and also that they're getting like 6%. They're getting like the company match, because he's saying that the employer match would also go towards paying off the student debt, which is nice in theory, but in his example, he said like 6%, which is like way above the average. The average is like 4%, and that's if you're lucky. There are lots of strings that are attached to your employer match. So there were a lot of assumptions with this proposal, or at least the example that he had provided on Twitter to explain his proposal. Something that I take issue with is the fact that, or, in my article, it takes issue with the fact that this proposal is stripping people, young adults, of one of the greatest benefits that they are provided by starting to save for retirement, if even they're only putting $25, $35, $75 away a month, and that's compound interest. So there have been many studies and very simple future value calculations that show that somebody who starts at, say, 23 or 25, even if they're putting less money away, that money grows substantially every month because they're putting in that contribution. They're also getting interest and investment returns and stuff like that, and they will see a nice nest egg. And if somebody were to put, say, the same amount of money or even a little bit more later in life, they might not see as much of a nest egg because they're starting later and they don't have that time on their side like a 25-year-old would. So if this, as this proposal is laid out, somebody would not be putting any money into their retirement account for retirement until like 7 years later. At least that's what the example showed. So I see where the senator was coming from, because student debt is a huge issue. But a lot of the financial advisors that I spoke to said that this is actually just it's not fixing one problem, it's just highlighting two problems, which is people need to save for retirement and student debt is out of control.
Yeah, actually, when I saw this proposal or heard this proposal, I thought of you, because I know that you would have very strong opinions about it, and I tend to agree with everything that you said. And we did get a private letter ruling. I was actually talking about this at a conference I was at during the week in Boston. We got a private letter ruling about Abbott Labs, and that particular private letter ruling, just for everyone's, from the Internal Revenue Service, basically said that Abbott Labs could create a program within their retirement plan to basically match, help for every dollar that a participant puts towards student loan, that the company could make a qualified non-elective contribution in addition to any match or profit sharing contribution that the company already has. And it kind of keeps, to your earlier point and to the point of the other financial advisors that you surveyed, it kind of keeps the money in the plan, keeps people participating, and doesn't take money out. I think the last thing we want to do, and I actually called Senator Paul's office and asked him if he would come on the podcast or the television network, but he did not have the time. I think with that particular proposal, taking money or leaving money outside the system is certainly not good, and I think you're right. It exacerbates two problems, not one. I think there are probably better structural ways to fix the problem, but I have, as you can tell, very strong feelings about this as well. But I would definitely say this. I love the fact that it's not just Senator Rob Portman and Senator Benjamin Cardin who are coming up with ideas. I love the fact that Senator Paul from the Commonwealth of Kentucky is coming up with an idea, and he brings a different perspective. So I think, going back to what we've always talked about, which is we need a national conversation about saving and financial independence, and that includes student loans, annuities, and all these other things that we tend to talk about in independent discussions.
Yeah, I think I love that people are talking about retirement and trying to find solutions. I just think that so for student debt, that by itself is a huge problem. The fact that we have so many Americans who cannot save for retirement or pay their bills because they have student debt, that's an issue, and that's a systematic issue that some people should look at as a whole. I think at the same time though, people are struggling to put enough money away for retirement or any money away for retirement.
Yep.
So a lot of the financial advisors who I spoke with, they were like, people already have trouble putting money into a retirement account. To then take it out would, they're hurting themselves or their parents' retirements. If parents say like, oh, well, I'll do that. I'll put, $5,000 of my own assets away. And it's hard to make that money up because you're not just losing the contributions at the time, but you're losing the returns or the potential returns that could happen. But I agree with you. I do love that they're talking about it.
Yeah.
And I do love that, he called it the Helper Act. He does want to help with retirement, which is always good. I just feel like hopefully we will talk about this more in the future, and there will be many ideas that we can all share and think about and create some sort of plan for. I'm looking forward to it.
Absolutely. Well, you keep up your hard work and effort to bring some of these ideas to light, and we'll do the same on the program and talk about them. And the more people listen and the more people share your stories, the podcast, the network, and all the other stories from all the other individuals on this program, the more that we can reach people and the more we'll have a conversation. Allie, always a pleasure chatting with you on a Friday, because that's when we record the show. Enjoy your weekend, and we'll talk to you very soon.
Great. Thank you so much.
Bye-bye.
Yeah.
Welcome back. Now we're going to shift gears, talk a little real estate and maybe a little personal finance as well. Joining me on the line, Jacob Passy, real estate reporter. I don't know what I was thinking there, Jacob. Real estate reporter with Market Watch. Hi, Jacob. How are you?
I'm good. How are you?
I'm doing fine. You have a great week?
I did. Busy, but good.
Yeah. Well, I think it's that time of year where we're all trying to compress more work into
Exactly.
fewer days, and the holidays are fast approaching. And we just had Thanksgiving, and we just had Cyber Monday and Black Friday. So just checking in with you on the real estate front, maybe the personal finance front too, because I know it's hard to kind of just completely leave that behind. So what's top of mind for you and the team at Market Watch this week?
Yeah, so I did a story, one story that looked at why a home should be one of the things you are shopping for this holiday season. So there was a report that came out last week, actually, but I don't think we got to chat about it last week. So there was a report that came out that looked at, basically the days of the year when homes are most likely to sell for, a discount relative to, the home's value. So, a lower price than it's necessarily, than it might have been appraised for. And all of those days are indeed in the month of December. It's 3 days, and they're all, right around this time of year. And that's not super surprising. There's a reason why, the spring home buying season is such a focus. Most people do try to, purchase their home in the spring, because then, by the time it closes, it'll be the very beginning of summer, and with the school's calendar and everything, that's, well timed to get you out of your old home and into your new home before the next school year. So a lot of folks don't like moving in the middle of the year for that reason. They don't want to disrupt their kids. But winter is, because it's slower, it's a great time to go shopping for a home. The prices are going to be lower this time of year, and especially in the next few weeks during the holiday season. It's probably not a huge surprise, but very few people are shopping for a home this time of year. More people are focused on traveling to visit family, shopping for friends, etc., holiday parties, all that. So, if you can fit in your home search this time of year, you can save some money. And I speak from personal experience. Looking back, my family, when we bought my family home, my childhood home, years decades ago, I realized my parents bought our home, in December. They, I think, closed December 29th, and they ended up saving almost $10,000 as a result of that.
Wow.
Because, no one was shopping. So, and that was like, in the boom kind of, that was, right before the housing boom started kind of happening. I grew up in Florida, so, it was right around that kind of span of time. So it goes to show that, that you should be looking, if you shouldn't, wait to look in the spring, just because you think that that's the best time to look. More homes will be available that time, because that's when people, tend to list their homes. But if you can start looking sooner rather than later and get your, mortgage, credit, approval lined up and all of that, it can benefit you a lot.
Yeah, it sounds like it. I never would have thought I never would have thought that the time of year really was that important. If you need a house, you need a home. If you need a home or a condo or whatever, that you just go out and get it. But that seems to make sense. I tend to be a contrarian, as many of the listeners probably know, and you probably know. So it seems to me like why not go to where less people are buying to try to get a better deal? And your comment about the 3 best days, I think it was your wording, are in December. I think that's really apropos, and I don't know why more people don't try to do that. They try to buy deals, get deals during Cyber Monday and around the Super Bowl. If you're buying a television, why wouldn't you do the same thing, Jacob, around buying a home? Doesn't make any sense.
Exactly, and a home is a bigger purchase, so you stand to save way more money from using, if you're planning on buying a home this year and also going holiday shopping right now, better to spend the time on the home buying search than on the hunt for a bargain on shopping on a sale at like Macy's or something, because in the long run you'll save way more on the home.
Yeah, and instead of going out and buying a Baby Yoda doll when it becomes available. Jacob, in terms of the home buying exercise, I mean, I know you no longer have the personal finance hat. At least that's not your dominant hat. But how about it just occurred to me, because we're talking about the holidays. Do people still do a lot of shopping at Bed Bath and Beyond when they're furnishing their homes, or the Targets? I mean, do you have a sense for people who do buy homes and do condos and whatnot? Are they still purchasing their goods at these brick and mortar stores, or do they tend to look at things online?
I think it's definitely a mix. I think it's definitely, there's definitely, I feel like for furniture and stuff like that, a lot of people still skew towards, traditional retailers, although I feel like the biggest, kind of change in recent years has been, the rise of companies like IKEA, obviously, that kind of, I think that, more and more people are furnishing homes with, furniture that they buy that they then assemble themselves. So some of that's bought online, but some of that is even bought, in a store like IKEA. And that is a good point. If you are planning to buy a home and whatnot, or move into a new home, and will need to furnish it, it can be worthwhile this time of year looking for those sales. And there are other ways you can kind of get strategic about this thing. So let's say you're engaged. A lot of people get engaged this time of year, and you're thinking of, starting a gift registry for, engagement gifts and wedding gifts. One thing that a friend of mine did that was very clever was they put a couch on their registry, on their wedding registry. It was a fairly expensive couch, and no one bought it for them. But they didn't expect anyone to buy it for them. But why they did that was because a lot of retailers that do wedding registries, they will offer a registry completion discount. So if you register for gifts that are not purchased for you, the Macy's or Bed Bath and Beyond or wherever will turn around and say, we're offering you 30% off of the remaining items on your registry, or 40% off. So, and sometimes you can combine that discount with, another sale that's going on. And so my friend ended up getting this couch, I think for like 40% off, saving hundreds of dollars on this couch because they put it on their registry. So no one bought it for them, but they, they needed a new couch, and they saved a ton of money on it. So you can get clever this time of year with that type of stuff, between, holiday sales and, getting engaged and, figuring out ways to save money here and there. So definitely something to think about.
Yeah, that's an amazing hack that I would have never known, and I wish I would have thought about had I decided to do a wedding registry. I mean, you can, and this goes back to, I think, a comment that you and I had. We talked a little bit about Black Friday, and I've talked about it on the show before, that if you hold out for a period of time and you put something in your cart, but you don't buy it, you oftentimes will get incentives from the retailers, and it sounds like that's kind of the same rationale.
Right, exactly. Yeah.
Jacob, just one more question before I let you go, and this is completely out of the blue, so I don't know if you'll have an answer, but streaming services are all the rage, and back in the day when you bought a home, one of the things that was really important to make sure it was wired for cable or it was wired for sound. Any sense or anything that you're hearing in terms of the future of new home wiring? Do people still wire their homes for sound? Do people still wire their homes for cable, for Ethernet? Given that we have Wi-Fi and streaming services now.
Yeah, no, so I do know that, in terms of like the design of new homes, a big thing has been reconsidering where outlets are placed because it's, not just, all the like, TVs and stuff, but now everyone needs to charge their phone, this and that. I know, I think of this when I get to hotel rooms, not that they're homes, but whenever I stay in a hotel these days, if it's not newly refurbished, the hotel room, inevitably there are not enough outlets for all the devices I need to charge, or the outlets are, there's no outlet really close to the bed, or there's only one, so I can't charge both my iPad and my iPhone on it. From it, or I need to get, a splitter or whatever, it becomes a huge headache. And so, I know home builders are reconsidering that, I think, homes can come with more outlets these days, and I think the outlets are also positioned somewhat differently. It's less about, I feel like the trend in the past was about all about hiding the electrical outlets as they were eyesores. Now you want them closer by. Also, a lot of homes are coming equipped with electrical outlets that already have USB ports built in because, if you can, that's a way of, spreading the wealth in a way with the outlet. You can have a few normal plugs and then a couple USB ports, and then you can charge all sorts of devices and plug in all sorts of things. Yeah. So that's definitely a trend. Another big trend is the smart home technology, and that's increasingly becoming something that home buyers are looking for is, the Ring doorbells and, all that stuff, Alexa-enabled microwaves, all of those sorts of technologies are really popular with home buyers these days. And the beneficial thing for people who already own a home who are looking to sell their home is, some of those technologies are easy enough to install without, any sort of major modification or renovation. Some of these things can, just plug in and, replace what's already there. So, there are ways that you can incorporate that. And then the last thing I know about in terms of, kind of updated wiring is as we all have more and more devices that need to run with internet connections, more homes are coming with, kind of advanced mesh systems for Wi-Fi, built-in, routers throughout the homes, things like that can improve your connectivity, especially in, larger homes or, I think everyone has, that one room in their home that's harder to connect to the internet from because it's really far away from the router. So some homes I've seen have had, these kind of upgraded systems built in where there are, extra routers or receivers throughout the home built into the wiring that, help spread the Wi-Fi signal more evenly across the home.
Yeah, well, I didn't think you would have as great an answer as you did, Jacob, because we don't talk about these things in advance. But I think we certainly appreciate it. And what I learned today, and I got to go in less than 30 seconds, is that doorbell viewer is good for Amazon porch pirates. I did not know the term porch pirate.
It is, yes.
That's
why people want it. I feel like it's the new version of the home security system, is the Ring doorbells and things whatnot.
But you're making sure that no one rips you off of the Amazon goods that you just bought online.
Exactly.
Jacob, always a pleasure talking with you. Very informative, and have a great, wonderful weekend. And we will talk to you again next week, my friend.
Take care.
Bye.
Yeah.
Welcome back, and now it's time to talk a little about what's going on Capitol Hill and around the country when it comes to retirement legislation, regulation, and so much more. Joining on the line, they are the Legal Eagles. David Levine, Kevin Walsh, both principals with the Groom Law Group, an employee benefits law firm based in Washington, D.C. Eagles, how are you today?
We are wonderful, Jeff. Happy December.
Happy December to you, and happy Thanksgiving, although we did talk around Thanksgiving as well, but hope you're doing well.
Well, no, it's David. Well, I got to say, Jeff, the phrase I'd like to use is Merry Christmas, Kwanzaa, Diwali, Eid. It's designed to cover most of the holidays in this section of the year.
Very good. Very good. Well, if I could do that, it seems like a really hard limerick or hard phrase for me to get, but I might have to phonetically spell it. So let's what's going on, guys? Because I know you were out in California talking about CCPA, and we've talked about it on the program before. But what's top of mind this week for the Eagles?
Top of mind this week is, and I know my fellow Eagle, Mr. Walsh, will definitely jump in because he's gone missing for the moment, is Yes, you know,
I'll participate. I'll participate.
I know we got to get a missing participant joke in every week for Kevin. But as of course, Kevin and I had the joy of being in California this weekend. It was a joy. We testified briefly at the Attorney General's hearings on the California Consumer Privacy Act. So instead of talking about Washington, D.C. this week, we're going to talk a bit about the CCPA privacy, what it means for employers and service providers, given this law takes effect starting in January. Kevin, you want to tee us up?
Yeah, so I'm happy to talk about what's going on in the State House out in California. And kind of the big takeaway for employers is that if you've got employees in California or you're doing business in California, and you meet a handful of other criteria, which are generally size related, then this brand new consumer privacy law that comes into effect January 1 is going to apply to your business. And in our world, in the world of benefits, kind of the focus is, well, what does this mean for retirement plans? What does this mean for health plans? What does this mean for some of those ancillary services and wellness programs that surround retirement plans, where, you know, maybe they take student loans into account, or maybe the employer's providing benefits in other ways. And kind of sadly, when the Consumer Privacy Act was initially passed, it didn't really focus on this. It was kind of more targeting what was going on in the tech industry, targeted advertising. You had some data breaches that got a lot of attention. You also had the Cambridge Analytica scandal. And so they came out with these kind of broadly applicable rules that provide rights for individuals when companies use their information. Now, during the last year, there's been a big pushback on the part of kind of employers who are providing benefits to folks, because those rules, if they applied to your retirement plan or to kind of the programs that the employers offer, they could really cause problems. So what California did is they amended the bill to have kind of a limited obligation on employers for 2020. And so simultaneously with that, new regs came out. So kind of where the rubber meets the road, and kind of the unfortunate fact pattern here is the regulations were issued the day before the amendment got signed. So what David and I were doing is we were out there kind of explaining that they really need to take the amendment that was enacted into account before they finalize these rules, because they really need to make it workable for employers and for service providers who are providing benefits to folks, so that we can continue, so the retirement services industry can continue to meet the savings needs of retirement savers.
And gentlemen, just
David,
like,
do you want to?
Oh, I was going to just interrupt. I'm sorry. I was just going to ask, and maybe David, you're going to cover this in what you were going to talk about. But did you find that when you were giving testimony that people were very receptive and understanding as it relates to our world?
Well, it's interesting you say that, because Jeff, when we were there, it was everybody in our world. We kind of live in our world and think of our bubble. And I think one of the fascinating things is there was lots of testimony from credit unions. There was tech companies, tech coalitions. But our world, there was one person from labor and employment, but aside from that, who touched on it briefly. But our world was not really at the center of the world. But the nice thing is the representatives of the Attorney General's office, they definitely seemed engaged. And when we were presenting, they seemed to hopefully, there's no guarantees because they can't respond then and there. But I think that the message got across, because we are a very big area that just hasn't gotten attention. And everybody always says you never want to draw too much attention. But the problem is these rules are kind of a square peg, round hole, as Kevin sort of was highlighting with his comments. So I think at this point, what we're really hoping, like, let's get to brass tacks, and I'll start with one, and then maybe Kevin, you'll chime in with something else if that works, is I think there's the notice requirement under the CCPA that employers are going to need to tell their employees how their data is going to be used, even with the legislation that passed. And there's federal law may preempt in certain cases, and that's a whole discussion that we're spending tons of time on with clients. But the real practical discussion here is that you're probably going to need a notice in a lot of these cases. And how do you do the notice? And we were like, look, don't try to put a tech notice in for the employee-employer relationship. It just doesn't fit. And we gave some ideas on that, and hopefully we'll do that. And I can tell you right now, people are just making their best efforts right now to do that. Kevin, I'm sure you have a whole bunch of thoughts too, so I don't want to take your thunder.
Oh, no, David, you're hitting on some of the key points. I think the disclosure is really where people are focused at the moment because, come 1/1/2020, under this rule, you're supposed to be providing a notice to your employees before you collect their data. Now, the contents of that notice in the amendment, it's relatively limited, but in the proposed regs, it seems fairly comprehensive. So I think what we were signaling primarily is there's a disconnect at the moment between the regulation and the statute with respect to this disclosure notice, and that a template would really help employers comply. The other area is there's a data privacy, there's a cybersecurity provision that also applies to employers, and I think we probably don't have enough time to talk cybersecurity and data privacy this week, but if you're getting ready for CCPA, it's worth keeping in mind that it's not just this privacy notice, it's this privacy notice plus reasonable cybersecurity procedures.
Great point, Kevin. Because cybersecurity, everybody talks about it, and it's important. We highlighted this in our testimony, and I apologize, Jeff. One thing that I think is a key just takeaway right now is think about what your security measures are. Everybody always thinks about record keeper, but we have lawsuits like the Estee Lauder suit and the ones on the East Coast as well that are out there, and it's important for people to say, what are my standards? Not just a record keeper, but all the other people who touch our process.
You weren't in, you don't have to apologize to me, David. You weren't interrupting me, and I guess where I was going to kind of go was, you talk about data, and I was going to give Kevin an opportunity to talk about missing participants because number one, we have discussed on this program e-delivery. We've discussed disclosures many times over, and this is yet another disclosure. And I'm just a couple of things came to mind, guys, and then I'll shut up in a second. But was like if 50 states and the District of Columbia passed separate rules, would you need 50 different disclosures if you were if you had employees in all 51 locations?
So when I look at California's notice, it seems to target employees who are in California.
Okay.
So you could easily see other states doing similar things with respect to employees in their states. Now, it seems like it would be a terrible idea and make plan administration very difficult, but who knows?
Yeah. And to Kevin's point, I think part of the challenge here is we love to think that our world is the center of the world, but it's part of the world. And this notice requirement relates, yes, to benefits, but it's to the employment relationship as a whole. So maybe parts of it could be, governed by federal law, maybe not. But you're right. If we have 50, 51, however you count it, given we live in D.C., states or territories to deal with this, it can become challenging quickly. But at the same time, there is litigation working its way up to the Supreme Court that's in the news the past couple of days about ZOL talking about limiting the scope of preemption. So you've got all these interactive plays going on, which makes it say that the balancing of state versus federal requirements is here to stay, and we're going to have to deal with that as we go forward.
Yeah, and Kevin, I want to just reiterate. I know you and David are both big on missing participants, but you especially, and the importance of data is not lost on me and probably the audience, and how important it is to find those people and maintain connectivity with benefits. So I just wanted to tee that up so you can get on your soapbox one more time.
Yeah, I think it's a key point where there's definitely a tension between some of the goals of different, like privacy is an interest, but also finding and paying people is an interest. And then even cybersecurity is an interest. And if privacy trumps these other things, it becomes almost impossible to meet these other kind of competing goods.
Yeah. Well, David David Levine, Kevin Walsh from Groom Law, thank you so much for another great segment and really informative. And thanks for doing some great work on behalf of not only your firm and your clients, but also the industry in terms of educating the AG's office on the importance of data in our industry. So have a great rest of the weekend. And of course, we will talk to you again next week.
Enjoy your weekend. Thanks for having us on.
Bye, guys.
Yeah.
Well, that wraps up this episode of BRN Sunday. Hope you enjoyed it. I hope you learned something along the way. And I got to say, those Legal Eagles, boy, are they funny, aren't they? So don't forget, tomorrow we are back on the TV network, BRN AM. We've got Devin Banerjee joining us there as well. So until tomorrow, until the rest of the week, and until next Sunday, I'm Jeff Snyder. Thanks for tuning in for BRN Sunday Podcast.
Unfadable, so please don't try to fake this. But back to the lecture at hand. Perfection is perfected, so I'm a ladder.